Hey, what's going on, everybody? It's Spencer from Gray Capital, and we are talking about not only the eviction moratorium, what does all the evictions mean, and are we actually witnessing the eviction tsunami that so many people in the media have been talking about since this pandemic started? Well, there's a really interesting tool that Princeton University has put out, and it's called Eviction Lab. But what that data shows is not actually, it doesn't really bring us to the real conclusions that we might make at first blush. So we're going to go into the details, really look into what it means, and kind of read in between the lines to really understand what's going on in some real estate markets throughout the United States. But if you find multifamily investing interesting, real estate investing interesting in general, subscribe to our channel, give this video a like, and you can hop on over to our website, graycapitalllc.com. We put out a lot of great content. We have a weekly newsletter that continually gets ranked as one of the best real estate newsletters in the world. So go to Gray Capital LLC and check it out after you subscribe to this video. So let's get into what Real Estate Lab is, look at some of the markets that are experiencing high levels of evictions, markets that are experiencing low levels of evictions, and what that indicates about the status of those markets. All right, let's get into it. So let's just take a look at some of these tools, just kind of go through the website, and then let's try to extrapolate some of this information and really dig into it to show us what it means. Because the reality is, if you just look at some of these numbers and judge them by, okay, states and markets have the highest evictions, you might see it as an indicator as a bad thing. There's something going on in those markets, but I think it's actually the inverse of what one's initial reaction may be. So they've got this really nice map, and this is obviously state by state. So again, just at first blush, what I find interesting is that there's some states with the largest populations that have the least amount of evictions. So look at California compared to South Carolina or an Alabama or a Mississippi or an Indiana or an Ohio. You see all of these big circles, concentrations of evictions, kind of in the Midwest and the Southeast a little bit. A little bit down here in the Southwest as well. Smaller numbers up here in the North, but these are pretty low population density markets, not as many apartments. But our two most populous states, California and New York, really are pretty small compared to, again, let's say South Carolina, which has an eviction rate of 8.87, compared to California, again, that has an eviction rate of 0.83. So that's a 10 times difference. In Indiana, which is our home state, we're at a 4% eviction rate. All interesting. So you would make these conclusions maybe that California is doing really well, South Carolina and Indiana, maybe they have some problems. Let's just dig into a little bit more of what is on Eviction Lab. So they have a list, top evicting large cities in the United States. Now, again, at first blush, you may look at this and say, these are the markets that I want to avoid. Must be issues going on in these markets. The economies just must be absolutely collapsing. But let's take a look at some of these markets. So we've got North Charleston, South Carolina, Richmond, Virginia, Hampton, Virginia, Newport News, Virginia, so quite a couple in Virginia, Mississippi, North Carolina, South Carolina, Michigan, Virginia, Tulsa, Oklahoma. And honestly, what struck me when I saw this list this is a list of some of the markets that are actually doing pretty well, just knowing that from our own market research in terms of occupancy, rent growth, and the economy. And so, what is going on when, these cities are at the top of the list, and this isn't even a full list, they just go to 100. Let's take a look at, for example, let's look at Los Angeles. They only have a 0.38% eviction rate. They're ranked number 234 in the large cities with evictions, but Los Angeles is a city that we see investors running away from, not to invest. And so there's conflicting data, and what data is more important. And I'm going to make a conclusion a little bit that it's really, I think, it's an inverse indicator for evictions, at least right now in the market. So again, one more thing that I want to show everyone before we kind of getting into comparing some of these markets and digging in, making some conclusions, is this policy scorecard. I think this is a pretty interesting tool. If you're looking into a market, you want to understand what's going on, what the policies, what the changes are. This is a really nice list of states that have enacted more or less measures related to COVID, related to housing. And it's interesting, you'll see there's no state gets a 5-star rating, and they drop off from even 3-star ratings after the fourth state. So after Hawaii, it drops down to Vermont, 2-star, and then pretty quickly you get down to these 1-star ratings. So not everyone is living up to Eviction Lab's, ideal policy set, but let's look at Minnesota. Minnesota's at the top of the list, and let's look at some of the policies they have enacted or are following. So initiation of eviction, no notice to quit, no filing if tenant has COVID-19 hardship, no filing for non-payment, no filing except for emergencies. That's hard to operate a business if you can't operate your business in a way that is essential. How does one, rent out property? To make a contract with someone to say, I will let you use my space, my property, you can live here. But then if they don't have to pay, how does that work? How does that function? And what we're going to get into is we're really examining markets and economies that are functioning and operating in markets that are not, that they have had a wrench thrown in the gears and they're not able to operate properly. And it goes to a further examination of really landlord-friendly states versus tenant-friendly states, how accommodating they are to business, to investing, and how well can you operate in those markets. And in my opinion, one of the biggest risks to real estate investing, but specifically multifamily investing, is government intervention, kind of getting in the way of the market, to prevent property owners and businesses to operate in a way that's necessary to conduct business and to be able to provide housing. Because if you don't have investors and businesses centered on real estate investing, you're not going to be able to provide the necessary housing required. So let's just look. Okay, so Minnesota, let's look at the largest city in Minnesota. Let's look at Minneapolis, see how it's doing with all of these restrictions put in place. One thing to keep in mind is, there are federal regulations, statutes, the CARES Act that was passed last year. Then there's state laws, state rules and regulations, and then there are municipal codes and statutes that are all going to be different. So you could have a more landlord-friendly city in a more tenant-friendly state, although the state may be encroaching on that municipality's ability to let landlords operate. But you can also have very tenant-friendly cities in landlord-friendly or red states. So we want to keep that in mind. It's not just a state-by-state issue, but it certainly can be an indicator. Minneapolis, let's just go back looking where they are on the rankings. So they're 201. They've got an eviction rate of 0.83. So again, one would say, hey, that's really good. You guys aren't evicting that many people. What's going on in the market? So this is a CoStar report. Just initially, just looking at some of these key performance indicators, occupancy is at the bottom of a 10-year average. Absorption is about the 10-year average. Rent growth is negative, almost to the negative side of the 10-year average. The rent is still increasing, but not at the same rate. It's declined. Cap rate is still low, but cap rates across the country are at the lowest they've ever been for multiple reasons. So this is a chart of absorption, net deliveries, and vacancy. Absorption is, new units are built, they come online. How quickly do they get rented and absorbed into the market? Net deliveries is, everything that was built and constructed. And vacancy, opposite of occupancy. So you can see they had quite a few net deliveries, and new supply will certainly put strain on occupancy and vacancy. But in a healthy market, you'd like to see absorption in net deliveries really be in line, or you want to see more absorption than you're seeing in net deliveries, and that's not what we saw in Minneapolis. You see net deliveries far surpass absorption. You even actually are showing, and I don't know if this is actually a printed number, this is in their forecast, but we are in Q1 of 2021, they have negative absorption. That's not great. So overall, in stabilized vacancy for Minneapolis, so the difference between, I believe, this orange line and this kind of blue line, forgive me, I'm colorblind if I get the colors wrong. This orange top line here is overall vacancy. That includes properties that are in lease-up. Property in lease-up is going to not be fully occupied, not stabilized, so it's going to bring that average For vacancy up, occupancy down. So the stabilized vacancy is a little bit more indicator of the actual market performance. But you see both lines, overall and stabilized vacancy, are on an uptrend right now. There was relatively flat, sub 4%, which is, very strong. It's been increasing pretty consistently. Absorption wasn't doing that bad, but again, it couldn't keep up with net deliveries and started declining. But this here, the daily vacancy rate, we've really just seen a very positive uptrend for vacancy, and that's not a great sign. And this is breaking it down between vacancy in CoStar does a star system instead of like an A, B, and C class system. So, the higher the star, the nicer the property. You can see the 4 and 5 star, the luxury A class assets are more highly vacant. It's probably because there's new deliveries coming online. The rents are higher, and these residents are a little bit more mobile. Maybe they're buying houses, whatever it might be. A little bit more consistency in the kind of the lower tier, kind of the 3-star apartments, but you also are seeing an increase in vacancy. Okay, so that's Minneapolis. Let's look at another example. That could easily be a one-off. We mentioned Los Angeles. Let's take a look and see how Los Angeles is doing. It's a similar story. Occupancy way down. Annual rent growth negative 1.5. Absorption is below the average. It's not at the lowest level in the past 10 years, but it's low. Let's get into some of these graphs. Again, absorption, net deliveries, and vacancy. A lot of deliveries, not a lot of absorption. Actually, negative absorption in the early half of 2020. Again, a lot of people are moving California. It's a high-tax state, a lot of regulations. And again, that's kind of the theme. This isn't all just about evictions. But what is the political environment of the markets that you're looking at investing in? How does that affect those residents? And it's not just that it's difficult to do business for investing in real estate. It's also for the people who are living there. They don't want to pay high taxes, and it's difficult for them to conduct businesses. That's why we see business owners leaving California, moving to states like Arizona, Texas, and folks in New York moving to Florida, or folks in Chicago moving down to Indianapolis. They want to escape high tax regimes, less regulated markets, and markets that actually work and function. Again, overall and stabilized vacancy. Again, just look at that uptick. And sure, we've only gone from 4% in 2019 all the way up to 5.5%. 150 basis points plus or minus vacancy. That's still not good. And when we look at some of the markets that are a little more free market, are a little bit more open on their rules and regulations, I think that's where we're going to see a big contrast. So again, major negative absorption, and then again, this daily vacancy rate, which I think is kind of the key graph that I want to keep referencing and to compare. So again, when I first saw Eviction Lab and I started looking at some of this data, what really stood out to me was Indiana. We had some of the highest, the most evictions since March, and I live in Indianapolis. We are invested all throughout the state, as well as other markets throughout the Midwest. I'm like, Indiana's been on fire. We've had our highest occupancy, great rent growth. We've been working with our residents to accommodate, but also, it's been relatively business as usual, being safe, trying to provide good housing. But we haven't shut down our businesses and not allowed people to come in and look at apartments just because of COVID. Again, being safe, putting all the right procedures in place. And again, I'm glad they have Minnesota on here as well, because you can just look at these two graphs. Indiana, you see a big drop, and we'll zoom in here in a second, a big drop off in evictions and then a spike. Again, that spike's scary. But look at Minnesota. Look at this drop off in evictions, and it's just flatlined. That's not a market functioning properly. That's a market that's not functioning. It's not realistic to have no evictions. So, and I wish that it went back further in time. It only starts, back in, I think, January of 2020. I wish it went back through 2019 as well, because I think it would give us a better average, because we're only looking at, a couple months pre-COVID and then just all COVID months. But anyway, so let's assume that, so this is March of 2020. And they have this average line, it came down, and it slowly crept up. They had, I'm trying to see if they'll tell us the actual number. Yeah, there are 20 evictions a week in Minnesota, the entire state. That's not realistic. That's not something that is operating the way it should. So Indiana, I think, makes a little more sense. So we saw a drop off from pre-COVID times. We dropped off. Eviction moratorium went into place. Couldn't do anything. No one wanted to move anybody out. But then, as the eviction moratorium expired July 31st, we could then start filing. So you see a gradual tick up because some people probably were filing even with the eviction moratorium. But as that worked through the court system, we see this increased number of evictions. But if you're really looking at the average, we're still below the average of evictions. And here's a better monthly eviction filings relative to average. So, we were a little bit above the average based on COVID times prior, back in January and February, but we haven't had one single month since the pandemic came into place where we have had evictions even at the same level that were occurring pre-pandemic. And again, I just want to reiterate, no one likes an eviction. Apartment operators, we're not excited to evict anybody. It costs us time. It costs us money. It's a failure because we thought that someone would be a great resident. We had an agreement. We'll give you this place to live. We'll take care of it. If you agree to kind of take care of it on the inside yourself, pay us some rent. We'll have this great partnership. Okay, we'll sign a contract, sign a lease. If people don't uphold their end of the contract they sign, things start to break down. And the only thing that Indiana is doing different from a Minnesota or a New York or a California is that we are abiding by contracts and allowing, again, these markets to actually function and business to occur. What is hurting the economy is shutting everything down and just not allowing businesses to function. Again, it gives us no pleasure in having to file an eviction. It's the last thing that we want to do. All of our property managers, we've been very proactive working with residents, pointing them towards government assistance programs, and just, if they've lost a job, trying to help them find a new job. But at the same time, there are residents who are, one, taking advantage of the situation, and then residents who just don't care and they're not looking to kind of fix the problem. They're just waiting for something to happen. And unfortunately, that may turn into an eviction, and they're going to have a kind of a messed up credit score, a credit report, because they're going to have eviction on their record. That's not great. Let's take a look at Indianapolis and a couple of other markets that are, at least in my opinion, functioning. Okay, let's get right into the KPIs. It couldn't be a more different story compared to Minneapolis and LA. Occupancy is at a 10-year high. Rent growth is at a 10-year high. Cap rates are way below, but if you paid attention to the cap rates in LA and Minneapolis, our cap rate is much higher, so we actually have a lot more opportunity for cash flow and returns in this market, even though we're blowing the indicators up in a positive way. So let's look at absorption, net deliveries, and vacancy. Again, so this is what you want to see. Where you noticed on LA and Minneapolis, these blue purple lines were much above the orange lines. And so again, the blue purple is net deliveries, and this orange line is absorption. You want absorption to be higher than net deliveries. If anything, you want them to be equal. Or you can have absorption after the net deliveries, but they need to be absorbed into the market. If not, you're going to have higher levels of vacancy. So we had some strong net deliveries, but bam, they were absorbed. Net deliveries, they were absorbed. Net deliveries, they were absorbed. Net deliveries, they're being absorbed. Again, the data kind of just tells the story. We're seeing a continual downtrend since 2011 in stabilized and overall vacancy, and a sharp decrease during COVID, during the pandemic. People are staying in their homes, staying in their apartments. Retention is going up. People are not wanting to move, and so that's not a bad thing for apartments. You can see absorption was very strong. We actually had the highest level absorption over the past decade. Stronger absorption in Q2 of 2020 compared to the previous highest quarter of absorption, and that was back in Q2 of 2014, and that's when the economy really started getting very hot and on overdrive throughout the last bull market. And again, Just letting the data do the work for us. Okay, so let's take a look at another market that is kind of at the top of the list. Let's pick Tulsa, Oklahoma. Okay, I think we're seeing a trend here. Again, occupancy 10-year high, absorption very positive in terms of the 10-year average. Rent growth, it's well above the 10-year average. It's positive, 3.3 is what you'd like to see. Cap rate still low. You might get some cash flow in Tulsa. Let's get into the charts. Again, this is kind of what you want to see. Had a decent amount of deliveries, but they were absorbed. Deliveries, they still need some absorption to go on here, but they're doing pretty well. Overall, and stabilized vacancy, this is pretty tight compared to normal. But we've seen a pretty decent decline since mid 2017. This looked like it probably had to do with a lot of new supply coming online. Let's see if that matches up. See here. A decent amount of net deliveries throughout 2017, pretty concentrated. And so that makes sense to see vacancy increase during that period. But since then, it has declined as deliveries declined since over 18 and 19. But over 2020, really what we're talking about, vacancy decreased pretty consistently. Okay, so let's look at another example, just again to hammer this point home, of a market that it's a big market. People love investing in primary markets. Let's look at New York City. Now, we know people have been leaving New York City for multiple reasons. They've got an eviction rate of 1.61, so it's a little bit higher than Los Angeles was. But I think New York City is a good example of a market that has a lot of regulations and is very, very tenant friendly and very hostile to business and landlords. Unfortunately, there are multiple regimes of rent control, state rent control, city rent control, all kinds of municipal rules and regulations. It makes doing business in New York City, in a lot of these kind of East Coast, or just really honestly coastal markets in general, a little bit difficult. So let's go to Jersey City. Let's take a look. And we can go in any submarket. I think it's going to be pretty similar, but we'll take a look at Jersey City. So the 10-year average, 87, they're down at 87% occupancy. That's really low. I mean, almost 5% decline in rent growth. They actually have seen some cap rate expansion. It's the first time today we've seen that. Look at this negative absorption going on in 2020. And again, the vacancy rate, it's the exact opposite we're seeing in more landlord-friendly markets. I encourage you to check out Eviction Lab. It has a lot of interesting information. But again, I think that their point is to track evictions, what's going on, and really trying to have an eye on the actual individuals, these residents who are being evicted. And again, that's important. We want to care for our community, the people around us, but don't look at these indicators and assume that a higher level of eviction necessarily means that there's something going wrong in that market. And in fact, what it might mean is that that market is actually functioning the way that it's supposed to. Again, we are not even at eviction levels that were pre-COVID. So there's no eviction tsunami going on. It's just simply not happening. Most owners are working with their residents to find out whether it's payment plans or assistance programs that are out there to keep people in their homes that are willing to work and kind of do what it takes. But what is not happening is or what we don't want to see happen is residents who can pay but refuse to pay because they don't feel like they have to and take advantage of landlords in states that they can't take any action. They can't take them to court, and they can't get in the way of someone who wants to just squat on their property and deprive that property owner of that rent and that income that they need to pay the mortgage and to maintain the property. Again, if the rents don't come in, you can't maintain the property, you can't pay your mortgage. And again, it's just this whole line in the system that starts breaking down because people don't have to do what they said they were going to do. Thank you for watching this video. Again, my name is Spencer Gray. I'm the president of a firm called Gray Capital. I'd love for you to subscribe to this YouTube channel, give this video a like if you found it helpful. And if you're interested at all in real estate investing in large apartment communities, hop on over to our website, graycapitalllc.com. We've got a lot of really cool resources for you to check out, including our weekly newsletter. We have a great blog. And then if you're actually interested in taking the next step, you can join our exclusive Gray Capital Investment Club. Again, hope you have a great day. Found this information useful. Subscribe. Have a good one. Thanks.